Have you ever wondered what the impact of the Federal Reserve's decision to raise interest rates could be? The Federal Reserve is a key player in the United States economy, wielding considerable influence over the financial markets. The decisions made by this institution can have far-reaching and lasting impacts, rippling through every sector of the economy, from banking to real estate, retail to manufacturing. Not only does it affect the domestic economy, it also impacts international trade dynamics. The topic of interest rates, specifically the Federal Reserve's decision to raise them, has been a focal point of conversation and analysis within financial circles. Experts, analysts, and investors worldwide have been dissecting every announcement, every signal, every nuance, trying to anticipate the likely consequences and draft appropriate strategies. It's a captivating, complex, and to some extent, a somewhat mystifying topic. Today, we are going on a journey into the financial world, to demystify this topic and gain a deeper understanding of the mechanisms at play. We'll be examining the chronological series of events that ultimately led to the Federal Reserve's decision to raise the interest rates, and we'll explore its subsequent effects. Let's go back in time, rewinding to December 2022. The Federal Reserve, in a determined bid to counter the swift and escalating inflation, took an audacious step. It raised its benchmark interest rate to a range of 4.25 to 4.5%. This was a level not seen in the last 15 years, a landmark decision that promised to have profound implications. The immediate aftermath of this decision was a drastic shift in the financial landscape. Consumers were suddenly staring at higher borrowing costs. But it wasn't all doom and gloom. There was a silver lining too, in the form of higher savings rates. Online banks and credit unions in particular saw a significant bump in their savings rates. We saw credit card rates reaching record highs, which led consumers to evaluate their options. Many considered balance transfers to credit cards with zero interest rate or opted for personal loans. One of the most significant ripple effects was felt in the housing market. Mortgage rates experienced a dramatic rise, causing home buyers and investors to rethink their strategies and plans. Mortgage rates, too, experienced a significant rise. Fast forward to June 2022. The Federal Reserve, the central bank of the United States, headquartered in Washington, D.C., known for controlling the country's monetary policy, made a noteworthy move. In a climate of rapidly surging inflation rates, which was causing the cost of goods and services to significantly increase, the Federal Reserve made an assertive move, one that was bold and important. The interest rates that had previously remained steady were raised dramatically. The increase was substantial, a leap of 0.75 of a percentage point, a move that hadn't been seen since the mid-1990s. The year was 1994, to be precise, a time when the economy was struggling with similar challenges. This move by the Federal Reserve was a clear signal to the markets, a warning bell to those who were paying attention that the status quo was about to change. In an attempt to combat inflation and rising prices, this decision was taken. The target was to slow down the rapidly growing economy. The method chosen was to make borrowing more expensive. Whether it was for homes, cars, or other personal loans, the cost to borrow was set to increase. This brought about a potential burden for borrowers, but also an opportunity for savers, who would now get more return on their deposits. However, despite the potential concerns and the increased costs, the stock market took this news positively. Traders and investors chose to look at the bright side, focusing on the commitment of the Federal Reserve to tackle the inflation issue. The result was a substantial rise in the Dow by over 500 points, a clear indication of a warm reception to the Federal Reserve's assertiveness in addressing inflation. In the end, the market's robust response showcased the trust in the Federal Reserve's ability to navigate the economic turmoil and signaled a positive outlook for the future. In March of the year 2023, the Federal Reserve, the central banking system of the United States, raised its pivotal interest rate for the 9th sequential time in just 1 year, all in an aggressive effort to combat the escalating issue of inflation. This decision, strategically calculated and executed by the nation's monetary policy-making body, had a significant ripple effect on the economic landscape. The raised interest rate, a tool often used to control inflation and stabilize the economy, resulted in an immediate elevation of lending rates. Banks, credit unions, and other financial institutions adjusted their loan and credit offerings matched the new standards set by the Federal Reserve. This translated to higher costs associated with borrowing money, which particularly impacted those who rely on credit for everyday purchases and significant investments. In an already debt-stricken society, the decision to increase the interest rate directly led to an intense surge in the cost of credit card debt. As credit card interest rates rose in tandem with the Federal Reserve's actions, the financial burden on consumers deepened. This new reality of more expensive debt posed a serious challenge for those struggling to manage their financial obligations. With higher lending rates and increased credit card debt costs, consumers found themselves needing to adapt to this new financial landscape. Financial advisors and experts began recommending various strategies to navigate this predicament. Some people were advised to shop around for superior rates, scouring different lending institutions for the most favorable terms. Others considered balance transfer cards with 0% introductory rates, which could provide temporary relief from high interest charges. Yet another solution that was proposed was to opt for fixed-rate personal loans. These loans, unlike variable rate loans that can fluctuate with market, offered a sense of stability in an uncertain financial climate. Through these diverse strategies, consumers hope to mitigate the financial blow caused by the raised interest rate. However, amidst these trying times, the significance of promptly paying off existing balances was stressed more than ever. By doing so, one could sidestep the potential for even higher interest rates in the future. The importance of this monetary strategy was emphasized, serving as a reminder of the power of proactive financial management in a volatile economic landscape. So, what are the main takeaways from this? Primarily, we must understand that the Federal Reserve's decision-making process is a one. Their decision to increase interest rates did not happen in a vacuum. It was a calculated move, driven by the pressing necessity to fight inflation, which, if left unchecked, can negatively impact the economy on a grand scale. This need to contain inflation was the primary factor behind their decision. Remember, these regulators are not just arbitrary decision makers. They are economists, financial experts, and strategists who take into account numerous variables before making any significant changes to the fiscal policy. They analyze economic indicators, consumer behavior, trade patterns, job market trends, and the global economic landscape, among other things. The intention here is to ensure the economic stability and growth of the country. However, the consequence of these decisions, while anticipated, might not always be easy to digest for the average consumer. As a result of the Federal Reserve's decision to raise interest rates, borrowing costs have seen an uptick. This impact is visible across the board. Credit card rates, mortgage rates, lending rates, all have witnessed a surge. It's consequential and it's felt by everyone, from large corporations to small businesses and individual consumers. This ripple effect has necessitated a change in financial strategies for many. Consumers now need to be more discerning while seeking better rates. They have to think about the options available to them: balance transfer cards, fixed-rate personal loans, and other financial instruments that might help to offset the impact of these increased borrowing costs. It's an ongoing process of adaptation as the financial climate continues to evolve. In conclusion, the Federal Reserve's decision to raise interest rates has had a ripple effect on various markets. Each hike, while designed to combat inflation, has significantly impacted borrowing costs. As we continue to traverse this ever-changing financial landscape, it's more important than ever to stay informed, to adapt, and to manage our finances with a keen eye for detail. It's not just about surviving, it's about navigating the financial landscape effectively.